Good morning and welcome to Coffee with Tom and Joanne. I'm Tom Matthews.
And I'm Joanne Toronto. Today, we wanted to talk about the hot button issue that is, making headlines everywhere, talking about rising interest rates and the rising interest rate environment as it pertains to real estate. So, right now, rates are still at historically low levels because maybe you have a parent that had bought a house in the 70s or early 80s and they had 18 or 20% interest on their loans. So right now we're still at historically low, but in recent history, we are looking at a rising interest rate environment. And we want to kind of talk a little bit about things that become more relevant in financing real estate when you're in a rising interest rate environment. So Tom, what are some options that people can consider when they're thinking about rising interest rates when they're buying a house?
Yeah, Joanne, that's a great question. And I think the best option is to look at adjustable rate mortgages. So in the mortgage world, they use the acronym ARM. So if you are wondering what ARM stands for, it stands for adjustable rate mortgage. Yeah. And what they can do is the bank can lend you money on a shorter term. So, historically people think I have to get a 30-year fixed loan.
Right.
But, what you can do is you can look at a 5/1 adjustable rate mortgage, which means that the rate is locked for 5 years and then it converts on a year-to-year basis after that, based on whatever the prime rate is. 7/1 ARMs, 10/1 ARMs. Those are the most common loans. And a lot of people say, well, why wouldn't I want to lock in a 30-year fixed?
Yeah,
well,
good question.
It's a good question. Some people do, but like I bought my home 8 years ago. I stretched a little bit to get into it and rates were a little high. So I did an adjustable rate mortgage. And I said, I am going to take the savings. I think I was saving the difference between a 30-year at that time and the adjustable rate was like, I think like $500 or $600 a month.
Yeah.
And I was able to take that monthly savings because I'm a fastidious saver. I took that money and I allocated it towards investments, college funds, other things. When you think about it over the term of 5 years, that's 60 months. That was a $30,000 savings. And Joanne, you have an experience with an adjustable rate mortgage, right?
Yeah, I also did an adjustable rate mortgage. And, because we work in a commission-based industry and we get, large sums of money each transaction, an adjustable rate was a great product for me because what I ended up doing was getting the lower rate on the loan, and I did a 7/1 ARM. So my loan was locked for the first 7 years and then subject to adjustment. What I ended up doing was when I got close to the end of that 7 years, I think maybe at 6 years, I was looking at the 30-year rate and it was the same as what I had gotten for, or maybe even a little bit lower as what I had gotten for the 7/1 ARM when I purchased. So in my case, I refinanced at that point to get out of the adjustable rate and into a fixed rate because that's what made sense. But in those 6 or 7 years that I had that adjustable rate mortgage, what I did was I compared it to what my payment would have been if I had done the 30-year fixed, and I simply paid down my loan faster.
Smart.
So it's not that I couldn't afford the 30-year fixed. It was just, being a little bit more savvy, looking at the margins and figuring out what your risk tolerance is, right? Because what could have happened was, 7 years into my adjustable rate, I could have wanted to refinance and then the rates are higher no matter what. And that's something that you have to take into consideration. But for myself, I was looking at the numbers and said, hey, I can pay my loan down. So even if I got into a higher interest rate at this point, the principal amount is so much lower that I'd be able to continue, with the current lifestyle and cash flow that I was used to. Right. So you can do 10/1 ARMs, you can do 7/1 ARMs, 5/1 ARMs. I think in some banks they do like daily interest rate, adjustable mortgages. So I would start, looking outside the box. The last 24 months, most people have been doing the 30-year fixed because the rates for that product have been so advantageous, and doing an ARM really didn't have much of a delta.
Right.
But as you get into a rising interest rate environment, the banks are going to now reinstate, a significant savings if you agree to an adjustable rate mortgage. So if you're in a position where you say maybe you get a bonus at the end of the year, or you get large commissions, or you're in an industry where you might get a lump sum at some point. I think it makes sense to look at the adjustable rate mortgage, but it's not a great product for everybody.
No.
If you feel like you need to know every month what your cash flow is going to be based on what your income is, and you have steady employment with steady income, then a 30-year fix is probably a good choice for you. As long as you're buying within your means.
I think it's a great product for like school teachers. You have COLA increases on your cost share of your income, but it's not going to be a huge jump. Having that 30-year fix locked in is really good, because one of the downsides to doing an adjustable rate mortgage is that you will have to refinance, and every time you refinance, there's cost out of pocket.
That's correct.
Usually a couple points of whatever your loan amount is. And so you really have to be in a financial position where you can absorb the costs and be in a position where you can really maximize having that monthly savings.
Yeah.
And that really, I think, really applies to people with variable incomes, more so than people with fixed incomes.
Agreed.
Firefighters, police officers, school teachers, nurses, people that have kind of a pretty set schedule of what they're going to make, with just cost of living increases, really should be in a 30-year product. You should be a little bit more conservative than people like Joanne and I, who's literally our incomes can change drastically from month to month, year to year. You have more flexibility. So we just wanted to introduce this topic because we're in a changing, the market's constantly evolving, and we want you to know there are plenty of options, because we ultimately feel the best time to buy real estate is when it's right for your family. And we just have to know the tools that are available to make that happen.
Exactly. Yeah. Well, thank you for joining us for another edition of Coffee with Tom and Joanne. I'm Joanne Toronto.
And I'm Tom Matthews. Cheers.
Cheers.